Welcome to the MUFG Global Markets FX Week Ahead podcast with Derek Halpenny, Head of Research, Global Markets EMEA and International Securities. It's Friday the 16th of February 2024, and joining Derek to pose some questions on the financial market themes for the week ahead is Jack Greenslade from MUFG's FX Corporate Sales. The following podcast is intended for professional investors and eligible counterparties only, and not for retail clients. Any content should not be regarded as an offer to conduct investment business or an investment recommendation, but for information purposes only.
Hi Derek, how are you?
Good, Jack. Thank you. And you?
Yeah, I'm good, thanks. The bit of sun today in London, so things look like they're picking
Indeed.
up a little bit.
Spring has arrived.
Exactly, yeah. It's been quite a busy week from the data calendar perspective, I guess, especially from the US and globally. And yet we're ending the week with the dollar, pretty little change. So why do you think the dollar has failed to hold on to some of those post-CPI triggered gains, especially given, the backdrop of weak growth globally?
Obviously we've just had the PPI data, so the dollar is bouncing on the back of the stronger PPI, but we're still below the highs that were hit on Tuesday after the CPI print. So let's see what happens. Obviously, in the rest of the afternoon after this PPI print, which was definitely stronger and has lifted expectations about the PCE data at the end of the month. But you could certainly argue that the reversal of dollar strength from Tuesday brings into some question whether the momentum at these levels is beginning to fade. What was certainly the case earlier in the week was that the dollar retracement from the drop in November and December had gone through the 61.8% retracement level, whereas rates had not retraced to the same degree. So you could argue that the dollar had overextended relative to the move in rates, and perhaps that has resulted in some of the momentum coming out of the dollar. Of course, we had the retail sales figure, which was weaker as well, which helps, I guess, explain some of the loss of momentum. I think, again, when you look at the broader flow of data, we have recession confirmed in the UK, recession confirmed in Japan, and we had Eurozone growth basically flat in the fourth quarter, the same as the third quarter, so basically no growth. And then, of course, you have the high levels of uncertainty in terms of the property sector in China and disappointing sentiment and growth there. So the global backdrop, you would argue, was certainly very favorable for the dollar to continue to strengthen. I think in part explaining that in terms of the fact that the dollar didn't get further benefit from the very weak data we've had this week. I think investors are kind of viewing that as rear view mirror data. And when you look at some of the forward-looking data, it's definitely indicating the potential for some pickup in growth. Here in the UK, the PMIs have picked up, consumer confidence has picked up, same in Europe. The Economy Watcher survey in Japan, again, this month we had a pickup in sentiment there. So I guess with falling inflation, that does have benefits for growth, and in particular in Europe, given the inflation shock that we had, the receding inflation and the speed in which inflation has receded does open up better prospects for growth going forward. So I think that helps to explain maybe why the dollar hasn't benefit as much from the weak growth. And then when we look at the kind of retracement of rates from the pushback on early rate cuts through rhetoric from central banks, it has been fairly synchronized. So, looking at the OAS market since the end of January, there's been a retracement in terms of the entire amount of basis points of cuts for 2024. So in the US, we've taken out about 58 basis points of cuts. That's probably changing right now as we speak, but before we come up, that's what it was. It's 52 basis points in Europe, and it's 45, 46 basis points in the UK. So the pushback on the extent of rate cuts this year has been broadly synchronized. And I think, therefore, there's no real appetite for significant divergence between the US and elsewhere, even with the kind of GDP that we've had. So I think that's kind of limiting the scope for big moves in FX. And I think that's potentially why, or certainly explaining part of the reason why the dollar gains haven't been extended. Although, again, all caveated with the PPI data as we sit here, and certainly the dollar is beginning to strengthen on the back of that.
Yeah, I mean, to be fair, we've had a bit of underperformance in the yen this week on the back of some of those weaker Japanese GDP and maybe some dovish speak from the BOJ as well. Dollar yen's rebounded back into a region you might consider to be the intervention zone. So what can we expect now that we're back above that 150 level and near the highs from last year?
Yeah, again, we're definitely in interesting territory, intervention territory, as you said, Jack. And of course, again, after the PPI data, dollar yen has bounced even further. So, we're getting to levels where I think intervention is a high risk. The high from last year is 151.91. So we're still below 151, but we're getting to nearly within one big figure of that high. And what I would say about the GDP data is, it was fairly marginal in terms of the contraction, minus 0.4% on an annualized basis. So, barely negative. But when you look at the breakdown, household consumption contracted for the third consecutive quarter. And what we can tell from the breakdown is that the inflation shock in Japan is a big part of why we've had these contractions in growth. And again, looking forward, given inflation's coming down, it's still higher relative to where we were before the inflation shock in Japan than in Europe or the US, where inflation's come down by more. So the shock in Japan is a little bit behind. But nonetheless, looking forward, again, there's better prospects for inflation coming down and that helping to support growth. But from an intervention perspective, from a BOJ monetary policy perspective, I don't think the GDP data does anything to change that. If anything, intervention, maybe the authorities are even more determined to stop yen weakness, because the inflation shock being a big story in terms of weak GDP, politically, the government are very unpopular, partly because of the LDP funding scandal, but also the cost of living crisis. And, given the weakness of consumption, they'll probably be more determined to ensure that we don't see any kind of pronounced yen weakness from here. And then from a BOJ perspective, we had Ueda speaking today in the Diet. There was nothing in his tone to suggest anything has changed, and it's still all about wages and the Shunta wage negotiations, and his communications in relation to that. He seemed quite confident that wages are going to continue to pick up. So I don't think it changes much. And given the fact that they've already communicated the potential benefits of removing negative rates, I still think they're determined to do that. So I don't think the GDP has changed much. And if anything, intervention has become a little bit more likely. And certainly if we test the highs from last year, we may see them allow it to break, but I think they would be pretty quick to intervene after that. So I still think the upside from here is relatively limited.
Sure. Okay, great. I mean, the question on my mind right now as well is, how do you see the trading views changing over the past week, given the data we've seen? Have you made any changes to your open trade recommendations? What's an update on that?
Yeah, so we still have the same two trade views open. So short euro sterling and long dollar Swiss. Now, to be honest, short euro sterling, after this week, the inflation data, then the labor market data, and I thought perhaps given the weaker inflation print, that, sterling underperformance may be a near-term risk that put some questions on a short euro sterling trade. But then, of course, we had that stellar retail sales print this morning. And yeah, we've held on to it. We have bounced pretty sharpish from 85, but we're beginning to slowly move back down again. So we're going to hold on to it, because I don't think the BOE's view on holding off on rate cuts has changed, even though we've had that negative GDP print. And then on dollar Swiss, yeah, we're well in the money on that, and more convinced on that view of long US dollar, short Swiss franc. And we had very weak inflation data from Switzerland this week, and that's brought forward the probability has shifted more towards the potential for a March rate cut from the SNB. And it probably won't take much more of a drop in inflation for the SNB to go back to the way we were before the inflation shock, which is concerned more about downside risks to inflation than upside risks. So, in that sense, I think there's potentially more to go in terms of Swiss franc weakness. So we've held on to that view as well.
Great. Thank you very much for your views.
Thanks, Jack.
Thank you for listening to this MUFG Global Markets podcast. Please rate, review and subscribe, and contact your MUFG sales rep for more information. Join us next week for more insights from the Global Markets Research team.